Okay, investors stretching those muscles, like getting back for a run after taking a bit of a break. We're looking at some mixed performance in North American trading. They had a long weekend in the U.S. We're down a little bit in Toronto, but the trend is still as follows. The North American equity complex is trading around record highs, and our next guest has remained quite constructive on the markets. Brian Belsky is Chief Investment Strategist at BMO Capital Markets and one of our regular guests. Hello.
John, good morning. Good morning, Canada. Thanks for having us.
Canada, the United States,
We're all
record
together.
highs. Yeah, everybody's been in a pretty good mood in the stock market, and that has not surprised you.
It hasn't. You know, what did surprise us, quite frankly, is that we didn't get that quote-unquote normal correction to the tune that we thought that we were going to get. We became a little bit more cautious, still bullish, but cautious on a near-term basis in late February, saying, you know, the market was overdue for a correction. Well, it got its 5% correction. Typically and historically, you see it around a 10% correction in year two of a cyclical bull, which we're in, John. So we still think that correction is coming at some point, but we do believe it's going to be from a higher level. So for those technicians out there, the dreaded, or the really positive a lower high, I'm sorry. So we're very comfortable with our year-end target now of 5,600 on the S&P 500, and we also increased our target on the TSX to 24,500. So if you look at the commensurate type of performance back and forth, we think Canada is going to actually outperform the U.S. the second half of the year.
I'm trying to do the quick math here. Can you give me the percentage?
It's around 5% to 5% upside
okay.
for the U.S. and around
good.
10% for the TSX.
Okay, and the catalysts for that, from your vantage point, would be what?
A couple things. There has been massive broadening out of the overall markets, and that actually favors Canada because of the more value and cyclicality. That's number one. Number two, why Canada will likely outperform is that if you go back historically and look at the three big sectors, when 2 out of the 3 big sectors outperform the U.S., that means that Canada should be outperforming the U.S. in general. But when 3 get going, then it almost always outperforms the U.S. So we think that there's a massive re-rating coming in financial stocks. I think that the momentum that we're seeing in materials and energy will remain. We think that really sets Canada up very well for surprising outperformance the second half of the year.
We'll talk about financials on the other side of the break, but let's lean into commodities right now. I hear a few things. I think with the material sector in particular, you hear that this is seen as a group that maybe acts as a hedge for anybody who's long-term consistently worried around inflation. And then the other narrative we've been hearing a lot about is if there is a insatiable appetite for power, that is going to benefit some of the raw materials that Canada is known for producing as well. What's your takeaway on the commodities related?
So it's a great point. In our portfolios in our overall Canada versus the U.S., we've been overweight gold now for several months and several quarters, and I think that's been the right trade. Unfortunately, we were wrong on Freeport-McMoRan last year, but we were very fortunate and blessed that we kept the stock this year. And so from the copper side of things and batteries and power and things like that, remember too that copper is an important part of EVs. And we think in general, global portfolio managers, because of the bad performance in Canadian materials last year, I think have been kind of underexposed that side. Maybe from your side in terms of the geopolitical risk, talking about that's why the gold perspective has worked very well. But from the other commodity side of things, chemicals in the U.S. And more of the clean commodities here in Canada, that's why I think we've had good performance in both sectors this year.
We talked to a guest earlier who said at the end of the despite the moves, that these are under-owned sectors, which is usually a conversation we have around energy, that it's an under-owned sector. But would you agree that some of these outperforming subgroups this year, beyond energy, have been like gold or some of the copper names, whatever, are under-owned by the broader North American investing base?
Very much so, especially on the copper side, because copper did so badly last year. Unfortunately, so many investors are near-term performance oriented, and because of the bad performance last year, I think they've kind of come back into it this year. Energy has been pretty consistent, especially Canada versus the United States. Energy in the U.S. is a smaller part of the index, so too is materials. So from a tracking error perspective, you can make portfolio management decisions based on tracking error a little bit stronger wise in the U.S. But in Canada, given where FERTs have been, John, and where the lack of really chemicals relative to the U.S. and where the strong commodity-based side of things, I think that is true that from the material sector in Canada, most investors are underexposed.
And then going back to the U.S. by comparison, where at the end of the day, because of market makeup, like market cap weightings
Correct.
within the S&P skews towards tech, everybody discounts a lot of what we're talking about right now and focuses on whether NVIDIA can keep rallying, et cetera, et cetera. But you have been bullish on the U.S. market, but for the same reasons that you're bullish on the Canadian market or other reasons?
Very
or?
much so. We've kind of coined it as the golden age of stock picking. We think the second half of the year will be about owning other tech, not saying goodbye to Microsoft, Apple, and those, but moving down in spectrum, not that it's really down to things like Adobe and Oracle and AMD relative to the big guys, quote unquote. And I think many people have also missed too that the Magnificent Seven, the makeup of the Magnificent Seven has actually changed, and Berkshire Hathaway now is number 7. And there's not enough talk about that. I mean, what an amazing company and how it's done. But I do think there's a catch-up trade in financials in the United States as well. So that's why in the U.S. we're overweight tech and financials and kind of playing that barbell.
You mentioned to our team that one stock idea in tech might be Snap, the parent of Snapchat, which it's down this year, actually.
It is. It was down a lot more. It's only down like 3% now, but it was down a lot more previously, and it's come kind of roaring back. Ad revenue is coming back, and they've pretty strongly in the most recent quarter. And I think from a platform perspective, it's getting a little bit more play. And especially take 2 steps back and think about what's going on in the communication services in general sector in the United States with this whole notion of, is TikTok going to come to the United States? And what does Snapchat mean to that? And what does social look like in the next 10 years? And we think Snapchat is going to be an important player in that.
And then finally, coming back to Canada,
Yeah.
we talked about a few sectors, but one investment idea, Stantec, they're in engineering, professional services, that kind of stuff. What is it about the makeup of a business like that that might sort of speak to your earlier comments on the Canadian market?
Yeah, so here's a stock that's up 4% year to date, 41% on a year-over-year basis. So it's had a nice run year over year, but we think it's one of those areas, John, that I think people kind of forget about in Canada, some of the industrial space and some of the consumer space. And Stantec kind of fits that bill as kind of a steady Eddie, longer term play that, again, it's one of these names in Canada that people kind of forget about. In the industrial space in Canada, if you strip out financials, materials, and energy within the TSX, industrials are 30% of the TSX.
Yeah.
So you have to have some exposure there.